We want to thank our primary sponsor and my employer by day, Nassau Financial Group. Our tagline is, working harder to be your carrier of choice. We support you with best-in-class service. We seek to keep things simple, and we'll have your back in the years to come. We're headquartered in Hartford, Connecticut, with $27 billion in assets and over 500,000 policyholders. We've been doing this a long time, 170 years, but we remain humble enough to always try to improve.
Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Mark Fitzgerald, how are you?
Paul, I'm doing great. Great to be here.
Hey, the stars finally aligned. We've been exceptionally busy the last month or so. It's great to have you back in your regular seat. We kept it warm for you.
Thank you. Great to be back. A lot of travel coming upon us lately, and it's been great to get back out there.
Yes, yeah. Lots of wine, but that's for another episode. California wine. Ramsey, good to see you.
Yes. You know, I was just realizing. So I live in Atlanta these days, home of the world champions, which is champion Braves. And it just sort of dawned on me that we're also live from Houston with our special guest, Mike Nelskyla. Mike over the years has been a competitor, a colleague, and a friend, and has really been in this space one of the most creative and successful people in the area of fixed index annuities and annuities generally, and he's embarked on a new project now that is doing quite well, and we're delighted to have him on the show. So, Michael, with that, tell us a little bit about your journey, in particular, what brought you to starting Save from your previous work you've been doing in the annuity space.
Thanks, Ramsey, and great to be on the show, Mark and Paul as well. Obviously we have some common history in the banking space, and during that journey, really it was a journey of the early days of 2012, I believe, when we launched some of the first index annuities in that space. That was really, it's an interesting development because in those times, innovation was very scarce, and it's the typical trend that you see in the insurance space is nobody to take the first step, but they're all waiting for somebody to take the first step. And so when we launched that first index annuity with custom indices, we saw a lot of ramp up in sales and a lot of interest from individuals and ultimately the end customers, but also the advisors, because finally it's something that is actually more relevant to what they were doing, because the options were either fixed index annuities or you had something linked to the S&P. There was nothing in between. Now, once we did that, obviously, then the floodgates opened and a lot of other carriers came in and started, using that same platform and the same mechanics. So, but that was an interesting period of innovation. But that led to Save and what we have here, and ultimately we're sort of doing the similar thing that we did in the index annuity space, but we're doing this time direct to retail, but in the banking space.
Yeah, and Michael, our paths have crossed, let's see, two different companies for me, and I think you brought some really interesting, solutions to the table. And innovation is just hard in the insurance space. I mean, I think we want to explore the need that you're serving, but in some regard, I think it's the same need, right? Like if you look at the customer at the end of the day buying one of these annuities, I mean, maybe we take a step back and you think about the custom indices, in your mind, what were the completely obvious needs that these custom indices were solving?
Yeah,
for
I'd say the some of the challenges in that industry are, there's many in terms of how it's a very cumbersome product. It's got a lot of mechanics around it. It takes a long time for a carrier to issue a product, and so I can see a lot of advisors going, well, how come I can't get this, and how come it takes so long, etc. And the reason behind that is that you have very sophisticated constructs behind it, of course, but then you have the whole system and the whole machinery behind it, and you have to get everything right. So whether it's issuing the actual product itself, then goes to distribution, then goes to everything around disclosures and the regulatory stuff, and education, and then roll out to the actual client audience. But if you look at the audience itself, what does the audience want? There's two pieces here. There's the advisor, and then there's of course the end customer. Sometimes they want the same thing, sometimes they're in tune, sometimes they're not. The advisor might be wanting the latest trend because they are very much in tune to the latest trend, but the customer is looking for other things. And I know you guys have been speaking about those demands for a long time, but maybe they just want safety. Maybe the markets are crashing and they just want safety. Or maybe they are, they're retiring and they just want, a coupon, and they just want the highest probability of getting that coupon. So those demands are there. Innovation is very hard in that space because of that machinery, and it's always a question who's going to do the innovation first, because that person or that entity will always take some risks, and many of these entities are very conservative in that way.
I mean, the thing that struck me was that you launched that first product, and the wave came, but the wave still took a few years. It was still a couple of years before the next version of a custom index came up, at least that I can think of. So it's interesting. Like there's a follow mentality, but it doesn't happen as quickly as you might.
It was interesting because I remember this was 2012, I believe we launched. It took maybe 6-12 months before we saw something that was meaningful as a trend. This was going to be a success, and I do want to mention that it wasn't just me. There was a whole team of people back at RBS and all the partners we had at the insurance companies. But it took a long time. But you can see that you saw once 6 months to 12 months had passed, you could see a clear trend in demand where the sales were ramping up, the demand was coming in, and we knew that we were onto something special.
Fantastic. So let's dig into how you've taken all those lessons from those years in the insurance space, coming from the perspective of as an investment banker, to now becoming an entrepreneur and launching your current venture. So tell us a little bit about
Save is effectively taking some of those concepts, and I'm going to be speaking in annuity type terms, so it's easier to kind of relate to it. But if you think about Save, then the easiest way to think of Save is a short annuity type platform, in the sense that what we do is we convert the banking products that exist into products that, instead of giving you a yield or an interest rate, give you market returns. So I think many people here, nobody's out there necessarily looking for a debit card. That's something that is seen more as a cash card. So what we did with that is actually we took the debit card concept and we said, hey, why don't we just take all the economics available in the debit card and we convert the debit card transactions into or spending into investment. So what we have here, and this is our first product, is effectively our Save Debit Invest card, and that one gives you a yield on your spend, which is 2 or 3 times better than what you see from other players. So that's the connectivity, and that's the bridge we built between the annuities type space, i.e. no risk to your capital, but potential for high yield. And that's kind of how we bridged it. And obviously there's more coming. We've got a savings account coming, and then there's also a credit card coming.
And Michael, looks like you have 2 different fundamental type accounts, the core account and the premium account.
Yeah, those are just actually coming out. They're on wait list because we were just about to launch them. And so what we did, we created bundles where now we originally had the debit card, and now we're adding the savings account to it. So now you have 2 types of bundles. You have the core account and you have a premium account. The core account just has your debit card as it is today and adds a savings account that gives you an average return of 1%. So again, this is not a guaranteed return, it's a based return, but the average historically is 1% over since 2006. Then the premium one enhances it a little bit. This is where interestingly, the financial product meets also trends in the market and customer and consumer demand. So on the premium side, we issue a metal card, a metal debit card, and that's also a rare occasion. Most people associate metal cards with the credit card space. So we're saying, hey, why not have? We're sure we have debit card users. In fact, half of the card spend in the U.S. is debit card spend, and nobody thinks about that. That's half. And so in that space of 4 trillion spend annually, there must be some people who want a premium type product, but they never have access to one because that space is really void of innovation. So we're issuing this sort of a metal debit card that there's a cost to it. But you get more for it. So getting obviously the matching of the investments on the debit card, but then you're now getting an enhanced savings account with as well. And so that one has 1.5%. And obviously the people who look at yields and returns and potential for returns very quickly will figure out that if you're paying, let's say, $15 a month, how quickly does it take to make that money back? Is it worth putting my money into this savings account and this debit card?
Yeah, no, you talked about the consumer needs. I want to see my money grow. I'm not looking to see double-digit returns on my money, but I'd like to have some level of safety. Mike, it almost feels like if I sort of tried to do a Venn diagram between annuity customers and potential customers you're selling to, it feels like there's potentially a lot of overlap with the people who are buying multi-year guaranteed annuities. I mean, is that sort of? It feels more like a MYGA product you're selling than sort of a
it's almost a hybrid of the two, but I would say the client is probably very similar, customer is very similar, because all of them are looking for one thing is really no risk, and then potential for yields, and whether what form yields take really depends. A banking product is typically associated with a fixed income type of yield, so an interest rate or something like that. So now that we've gone into that space, people are expecting a fixed income type or that type of return, but we're not doing that. We're doing a index type return. So it is a kind of a hybrid type instrument, but the client is very similar and the demands are very similar. So you look at today's world of low interest rates. You look at, you guys talk about this all the time about baby boomers and the large groups that are retiring and nearing retirement. Obviously, those people are all looking for a solution in this world of low interest, because there was a time 10, 20 years ago where you could put money in a bank account and feel that could act as your annuity, that could give you something back. That's no longer the case. No matter where you look for it, especially with inflation peaking. You're basically losing money if you're not doing something different. And so we're trying to bridge that gap, similar to annuities are trying to bridge that gap, but we're doing that in a different manner in the banking space. And maybe the difference is that we end up being very close to the customer. We're direct to retail or direct to the customer, or in that sense that customers will sign up to our website, they'll get the card, and they can get spending immediately. And we are so close to the customer that this morning when I got a coffee at Starbucks, I was using my debit card, but I was using Apple Pay, Android Pay, and so I just tapped the machine and paid $5 for a coffee, and I got a notification saying Save will invest $5 for you in your chosen portfolio, and you get to keep the returns. So it's it's similar needs, but we're direct to consumer. In the sense that we call it very portable. It's a very portable tool to constantly, in your daily spend or daily behavior, generate returns.
So it sounds like it's obviously a very complementary product to really any other type of investment instrument out there. I mean, people that have annuities also have checking and savings accounts. This is an alternative to that. You also have a referral program, and I guess my question is, from our audience's perspective, agents in the field, can agents sit down with the
Yeah,
client and generate a
they can.
referral
In
to
fact, they can,
this
because the
as a
way our
complement to
referral
products that
program
they're
works
offering?
today, and these are initial setups we put in place, but just for the debit card, which is the basic account. Today, it's $1,000 invested for you and $1,000 for your friend or the person you referred for that referral, and that means that anybody could be the referrer. It could be an advisor, it could be a friend, it could be a family member. But ultimately, we're the referral component benefits both, and this was actually inspired partially by Tesla, but also partially by, if you think about it, we're making a very boring product. I mean, nobody looks at their savings account. Actually, nobody probably looks at their annuity daily either. But we're making a very boring product, something that you can follow and be excited about on a daily basis. So the other inspiration was Casper, who were actually, if you're familiar with them, I mean, you can't find a more Casper mattresses. You can't find a more boring product than a mattress. And who would have thought that you can get referral bonuses from, referring somebody to buying a mattress? But they did it, but they did it in a way that, it was equal, meaning both got a referral bonus that was equal. And this way, you feel that there's merit for both people. Then the referrals actually become more valuable for both parties, and therefore it became a success. So both Tesla and Casper, both are different. One is technology, high technology. The other one is no technology whatsoever. But both were very successful with this referral program, rewarding both people. And so we've taken that concept, and as one of those ones, we've introduced it into a banking product.
Listen, I'm bullish on the referral program. First of all, I've had free electricity on my car for 4 years, which is great. We have a referral program for our MIGAs, and we've had pretty surprising success. I'll say on it. Kind of like us, though, you can't put on your website or the window of your company.
Yeah, interestingly, we can actually say FDIC
How do you build
insured.
trust?
So that's another thing we built into the system. But I'm going to say that how it works is maybe differently than a typical bank. So when a customer comes in, any cash that they put with us, and so let's take the debit card as an example. Just in order to spend money, you're going to have to put money into a bank account. That bank is FDIC insured. Now, then as they go on about their spending, at that point, you're getting returns. Those returns, until they land into your account, aren't FDIC insured. Those are, subject to the typical securities type insurance, SIPC. And so I'm going to call it that we have an FDIC insured component in our business. The rest is SIPC as per the investment side. But going back to your question, how do we have clients? We don't use the FDIC component a lot. It's something that people expect in the banking space to just be, a participant in the banking space. But in terms of attracting clients, we mentioned the referral program. The other thing is trying to make it easy, really, for customers to adopt our product. And we hope that a debit card and a credit card and a savings account is the easiest component, meaning we don't have a sales force, so we're not selling the product. In fact, we did the opposite, where we say, let's build a platform and people can participate in the platform, and they can, participate for free. So we have an app. People can download the app. They can test us out, and then they can choose what kind of category of service they want. There's two. The category is what we call online or app-based only. So they can use that app, and they actually don't get a card sent to them, but they have a virtual card, and so now they can use a card and fund the card, but they're not getting a physical card, and they're not funding it with a lot of, maybe they're funding it with $10. That is the easiest way of just trying it out, because many people will say, well, you know what, I'm used to getting nothing on my bank account. Now you're saying this potential for so much more. I don't believe you. I want to try you out. I want to actually test it out and see what happens. So we have a lot of those people trying us out on a regular basis. Out of our almost 20,000 customers now, a lot of them are testing us out. But and hopefully they all convert. But there's a lot of that ease that we're building in order to get that the customers to understand what we do.
So, Michael, in a professional referral situation, let's say it's an agent referring a client.
No, this is this referral is a non-cash referral, and so it sits under the purview of the SEC, and so this is not an insurance product. But in that context, typically you'd have to become a solicitor or something similar to that. Mm-hmm. We don't have that because we are under non-cash, and so getting exposure to a portfolio is non-cash, and that's not a requirement until the new regulations come in sometime, I believe, end of next year. And so in other words, I think we have a limit of 250 referrals, so $250,000 maximum, just to keep it so that it isn't a business on its own. That is real customer, real connections and real value added to people who really want it. But other than that, there's no limitations, and people regularly, actually, we have people who refer, let's say, 20 people or 40 people or something like that. And certainly in the more influencer type space, in the advisory space where you might have more connections, certainly we have more referrals there.
So for me, as I listen to you, Michael, there's so many remarkable things about what you've set up here. So for one thing, if you think about it, like not everybody has an annuity, not everybody even has a CD, or most people probably have bank accounts, but for sure everybody spends. Like everybody spends, and they spend every day, and you've created this product, where there's this daily interaction. There's this daily interaction with your service. There's daily interaction with having an understanding of, or hopefully, sort of an self-education on the part of the consumer in terms of better understanding the investment component of it. And that's as I listen to you, the fact that you've created something that creates daily engagement around this is beyond everything else. The fact that you get people touching it every day is remarkable. It's something we all seek to do, right? In educating clients about the various products we sell as well.
Yeah, so I'm going to say,
congratulations.
Here's what's fascinating, right? And what we love, and again, this is our mantra is. We're not never taking risk. Customers can, everything's FDIC insured, and they don't have risk, and so they're getting investments effectively for free for their transactions. So that's a matching type thing, and that's great. But I think where we try to go even further is think about you might I'm sure advisors and others listening to your podcast will say, many times they'll encounter somebody who says, I don't have that much savings. I don't know what the minimums could be, 15,000 or 25,000 in some cases. I don't have that money. So how do I get on board this savings train or retirement type, activity without those savings? One of the fascinating things is that let's take the average debit card user in the U.S. and I'm going to say they are maybe in many cases low affluency, and maybe they spend $400 monthly on the debit card. And they may have no savings, very little. But what we do, and let's say it's $400 monthly, what we actually do is that if they're spending $400 monthly, and that then accumulates to, with our card, $4,800 annually, they've invested $4,800. That's $4,800 they would have never invested, and they would have never, got the returns off because they never had 4,800. So by doing that match, we just converted a small or almost a zero investor, historical investor, and even maybe a small spender to a large investor.
So let me ask you this then. So if you think about what the typical customer profile is, let's just say generally in our industry, it could be on the RIA side, it could be for insurance agents. There's a certain profile, certain amount of savings, et cetera. For your business, what do you see as your typical customer? Because it sounds like it's in many cases it may be somebody that doesn't have a lot of money, or they could have a lot of money and spend a lot of it, and they could still be a customer of yours, right? So tell me about how you
Go for it.
how you are targeting your customers going forward, and what audiences you're looking at.
Oh yeah, and before you answer, we could almost take a bet. Let me just sort of set this up, and make it interesting, Mark. So let's see, 20 to 30-year-olds, they're fascinated with digital currency, right? Right. Too old, like our average age of our customers are like in their late 60s. You know this, Michael, right? So would they be interested in this technology? Maybe a handful of them. Okay, I'm going to bet it's like 30 to 40-year-olds who are in urban areas. I don't know, Mark, what do you bet?
It's spot on.
I bet that's
So on the
probably
debit, so
current
again,
model,
we're
but I
building
think the
a
model
suite of
opportunity is
products, and
probably more
obviously,
in the latter that you mentioned.
as I said in the beginning,
Okay.
the debit card user isn't. Most people who have a credit card only use the debit card for minor items or just cash. So you do have this affluency step between a debit card holder and a credit card holder. And so to answer your question on who are our clients, I'm going to say that you're right that on the debit card currently it's somebody between 25 and 35 years old. Could be lower affluency, or they're young professionals who love, as you said, love the technology, love that they're smarter and creating something better out of their spending. So that's one group. However, as we move to the savings account, by definition, for you to get the 1.5%, then you're gonna have to actually have savings. So we're already going up on the affluency there. And then as we move to the credit card, which is going to be sort of at the platinum Amex type level. So it's slightly higher in terms of affluency, sometimes high net worth as well. Then obviously that type of user has got a different spending pattern altogether. So that type of user would spend $5,000 monthly easily on average. And so it is effectively, we're taking ultimately we're tackling all groups and all segments, but these are different products. So again, going back to Tesla, as a good example, what did Tesla do first? They create an expensive car, so the Model S, and so that wasn't achievable, a target. It was only for the few, yeah. And then as they progress, they go down towards more affordable alternatives, and we're effectively building that same type of ladder.
So, Michael, in terms of making deposits into the program for the savings side of it, can you do direct deposit?
Yeah, so
from
currently we
Payroll,
have
Social Security,
so you can
for
deposit
checking
direct
accounts,
money
and then
directly from
on
Payroll. We have,
withdrawal side,
I think
are there
10%
any
of our customers
limitations in
do.
terms of timing
And
behind
so
that?
the key is to become ideally the first, the top of wallet, as they say, or the first point of contact in terms of the banking relationship. It's harder when you just started to be that, because the large banks have more services, but we do have a lot who already deposit their salary directly in there. And then in terms of ACHs and transfers, today we have it's $10,000 is the limit. As we move on to the savings account and the credit card, the savings account obviously will have only the FDIC limit of $250,000, and then on the credit card, there's the spend limit is technically unlimited, in the sense that as long as you pay your bill, you're good.
Yeah. Well, maybe we just drill a little farther into sort of the consumer need of, I want to optimize and get higher interest. We talk, and we've seen we've had some interesting guests on here. We've talked to some people outside. I don't know, Michael. I see at least two strategies. One is, and I saw one bank out of New York, won't name them, with a sort of what I describe as high almost like a brokerage account for bank CDs. So you put the money in, and you have they weren't CDs, excuse me, money market accounts, and you could rotate your money among, say 30 different accounts. So kind of optimizing other bank programs. We've seen sort of what I'd almost describe as hybrid, where somebody's gone to the banks and the banks have had some sort of a unique product to offer to optimize interest. You've got sort of a third strategy. Is that the universe? Now, and I would say on the annuity side, listen, we've got our MYGAs, but you got to be, you need to be over in your late 50s for this thing to, make sense, for the value. So you're limited by products. Is that the universe of strategies? If I'm just saying, look, I've got money sitting.
Yeah, I'm going to say that.
Why am I getting nothing?
So
and I guess
interesting phenomenon is that
one,
the first products, if you go back to 100, 200 years, the first products were all fixed income type products. So you were taking a loan, or you were giving a loan, and you were getting a coupon back or some sort of yield back. And it was only when the equity market started to become a force to reckon with, and that those equity components were introduced into any product out there, and whether that's annuities, that's any other platform that exists today, Robinhood, etc. What happens is an interesting phenomenon. People want the equity return, and they will take that rather than the fixed income. So to answer your question, I think this is just the beginning. I think all banking products should have 2 or 3 options. You can choose the fixed income, similar to annuities. You can choose the fixed income component, meaning you get 25 basis points, 50 basis points today. Or you can take, another option, which is a market return, but that's not guaranteed, but you can get more. And then you go down that path of saying, okay, well, here's another one which may be a little bit more illiquid or an alternative type structure, etc. Now you have the same option, but history has shown that every time you introduce equities or equity components into any product, it dominates. It takes over the market. And so that's hopefully what we're touching upon here in terms of trends. And there's one thing what is very crucial in this market in terms of creating that innovation, and we're trying to tackle that on our side. And this, I believe, is going to be a trend in the insurance space as well. As you create these new innovations, and they're equity-based, now it comes down to, well, who built the equity portfolio? What is it? What are the fundamentals around that? Is it a group of experts, or is it just the S&P? What is it? And then equally, taking accountability for that. So what is difficult right now is, as interest rates are very low, to actually get something that is meaningful in front of the customer, whether it's on the fixed side or on the market-based side. It's very different. And so what we did is we said, hey, let's make it even easier for us and the customer. Let's align ourselves fully with the customer, and let's only take our fee if we're successful for the customer. And that's another first one in the banking industry, certainly, is that we don't charge our management fee if there isn't any return. So in other words, we hopefully won't have customers who come back and say, well, there wasn't the return I expected. It was lower than I expected, and now I'm upset, because we will be upset as well, because we won't be getting any fees and we would have failed in giving those returns. So we've aligned ourselves fully, and what that enables us to do is get those returns that you see. So some of those returns that we're generating here are the fact that we put all economics at work for the customer, and we only take a fee if we're successful in that exercise.
So, in a sense, are there 3 ways that you can technically earn?
Yes,
money
correct. So we did a little calculation where we said, well, let's pretend we're the average saver that uses let's say deposits 40,000. We did a survey across regional banks, and the average seems to come out at 40,000 in savings. And then that bracket would if they use a credit card, then will spend, let's say, $3,000 monthly. On their credit card. And then they will, obviously that will vary in terms of how many referrals they make, but let's say 1 or 2 referrals a year, just to be, on the conservative side. Once you do that exercise and you look at your total yield on everything you're doing in terms of what you put in and what you got out, so return on investment, you're looking at between 5 and 7% on your cash or on your outlay. So that becomes actually a bigger component is once you start building these components back in to your profile. And some people who are actually not using currently using debit card very little, but they're referring. There's one that referred 150 people. And so you can imagine how now they're spending very little, but they generate enormous amounts of returns for themselves, because it's no different than when you go to use Uber and you refer a friend and you get a discount on your fare. You just got a gain. You made a gain, but you didn't pay for that gain. You actually gave it to your friend and you got something in return. So that's another way of generating yields is actually referrals or spending or of course the typical standard savings. But combining those three, it becomes very, very powerful. So the referrals are currently matched at $1,000. Minimum spend is So
max,
here's the only criteria we have is if you are referring people, then you at least have to have spent $250, meaning you are using the card. And so that's the only criteria. It's once, it's a hurdle you hit once, and that means you've qualified as being an active customer. And then you're off to the races. You can refer as many as you want. No, sorry, 250. Sorry, I thought you meant the minimum spend. 250 is annually, is what we set up annually, simply because we're trying to be prudent. I think Paul, you'll know from Tesla as well with the referral program. What they say is, let's try to make this genuine and let's keep it genuine between people who are enthusiastic about the product versus somebody who creates their own referral business. Yeah, and so we're trying to keep that reasonable. Yeah.
Business model, right.
Yeah.
Can I ask a question? Go ahead.
Yeah.
I was just going to say, so why wouldn't it be okay for somebody to have, a referral business? Like if I think about just economically, maybe there's some regulatory reasons behind it that I'm not, immediately seeing, but if you had, a number of influencers that essentially went out and referred, 150 each, right? And they get $1,000 of exposure for each of those referrals. That's $150,000 of exposure to whichever index they happen to choose. You can see why that might be right. Why that might be like a really interesting way to build customer acquisition. So I'm curious why you want to put a cap on that, and maybe there's a piece of it I don't
like.
I'm
the
not
further
seeing.
you
Like,
go, so let's say there's one individual that refers hundreds of customers.
They want to be friendly
at
in
that point,
business,
that
why not? Why not?
There's at
Why
least
not have it be a business?
100 customers there who they might not even know. Yeah. So what happens is this information dissemination. We're trying to be we're a discretionary advisor regulated by the SEC. We want fair and balanced disclosures. The risk of them not telling anyone what it is quite high once they start, creating a business out of it. They're just motivated by money or gains. And so, that risk is exponential once you move out of the initial friends and family type of sphere. And so we're trying to restrict that for that reason, so that there aren't, the customer number 249 or 250 of one individual or referral number 250 doesn't know anything about the product. It's just sort of following the rest. And there's nothing wrong with that per se, but we do want to have customers who understand and love our product and are engaged, because equally they will be motivated by the product, not just the referral benefits. And you see the same effect at Tesla. I think they can as well. I think they also put guardrails around it to ensure that there's fair and balanced type of activity. And what you may see, certainly on Tesla's side, you may see people creating their own advertising and things like that, and it may skew the reality of the product itself.
Well, yeah. It's I think like if I were in your shoes, I think one problem is you want to protect your brand, right? And if you've got spammers from Malaysia sending
Exactly.
hundreds of thousands of emails with a link, that's not good.
Right.
What were they representing? Oh, this is a savings account. Click here. So misrep. However, like Tesla's interesting. You've got a lot of YouTube channels. Car enthusiasts. Hey, here's how I'm going to do a review on the next model. Please use my referral link if you liked it. So I think my perception on Tesla has been they've restricted it. The way it only makes sense when you're making money and customers, you're attracting the right customers. But at what point do you not need the refers, right? So what they've done is that the referral, the benefits have gone down, 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 down. It was, hey, free electricity for life. Okay, everybody came in. I got the referral code. I think now maybe if Mark takes my referral code someday, Mark, if you click on that thing, still waiting.
You guys both have Teslas,
right?
No. He only likes things with gas in them, right, Mark?
I like the engine sound.
Yeah. So now I think if Mark clicks on it, I don't know, maybe I get like a free extension cord, for my car. So I think I'm exaggerating, but I think that's kind of where I've seen Tesla, take their program. But it's powerful, Michael. It's a big. I think a couple of big ideas I've heard from you is, anytime you attach equity to a product like this, equity starts to dominate. You've got something really novel here. Right, and I baited you a little bit with the FDIC.
Yeah, and I think look, there's certain things people even search for on Google.
I think that's
like
powerful.
a debit card.
Referrals are powerful. Those are good ideas.
The only ones that would search for a debit card are maybe a fraudster or somebody like who's trying to find out who's a startup I can take advantage of. So nobody searches for debit card. So that Google doesn't even come into play, and so it becomes a hard audience. And many of these debit card holders are tied to their existing bank or whoever they may be because of their relationship there. And then you look at customer acquisition cost in the industry, whether it's Tesla or others, combined with the power of referrals, meaning and advisors certainly who are listening to you guys, they are all into referrals, and because they know that those relationships are not only the strongest, but they're also the most sustainable. Meaning, if you were referred by somebody else, you become your lifetime as a customer is much longer. Over any industry, whether it's financial industry or other industry and other industries. So this referral program is really trying to capture the enthusiastic people, similar to Tesla, similar to Casper, and through that build not only, as you said, brand equity, but also create this environment of safety where equally we could be marketing on Facebook and otherwise, and people could misunderstand that message. But if we have a passionate customer, as you said, they're so passionate, they're talking about the product in very small detail, like the Tesla enthusiast. They'll say, look, it's got this and it's doing this, and they go out and correct people who say wrong things, which is awesome. So now you have defenders of the brand, you have defenders of what we do, and ambassadors who really are passionate about it. And once you build that, then others will come in.
Come back to the earnings on the portfolio itself.
So we have currently we use it's 30 ETFs. It varies. There's currently three portfolios. They correspond to three risk categories. So you got conservative, moderate, and growth, and you will be allocated to one of those depending on what when you fill in the application, etc., based on your risk profile. But these portfolios will vary only with a few components based on risk then. But it's 30 ETFs. It's the same or more that you'll see at any robo-advisor out there. Typically, we're broader. The reason why we're broader, meaning we take in more markets, more asset classes than others, because we have a target in mind. And that target is to create a low but stable return. And that's similar to what's happening in the annuity space. It's very hard to create a product that creates, especially like if you're targeting or competing in the credit card space, where people are used to their points coming in on a regular basis, we have to create a product that, and same in the annuity space, you have to have a product that has potential for returns on a regular basis. They don't have to be high returns, but they have to be persistent, and they have to have a high probability of occurring. So we take those 30 ETFs, we apply, risk parity, we apply trend following signals, and then, risk control on top of that. But we have that broad portfolio to try to capture those returns. They won't always materialize. You have a chance of, I believe we calculated, you have a 15% chance of getting a zero. We trade monthly, so let's say that 1 or 2 of the months that you've been spending, those returns will end up at zero. But then it's only at the same as your current bank account or your same as your current debit card. But after that, the average return is expected to materialize, meaning around 3% on the debit card. So I don't know if that answers your question, but ultimately these portfolios are built to be low, but with stable returns, low volatility. Yeah. It's very similar, yeah. We're even lower volatility, so I don't think you've been as low as we have. We are, so.
Yeah, we could almost take what you described in
Tesla and save, I think.
Right?
Well, with no downside, right?
Yeah.
So it sounds like Paul's been kind of.
Yeah. So we have an Android app. We have iOS apps.
So
we have the full.
Right, exactly.
I'm sending you the Saver. I'm sending you the Saver one.
Pay,
so when it comes to signing up,
Apple Pay, Android Pay, and so you can just tap and
or
pay, and off you go. Whatever you spend. I mean, I have great anecdotes of people calling us up and saying, "Oh, there's somebody's paid for their wedding with a debit card." I think that must be first in the history of debit cards. Somebody paid for their air conditioning to be installed in their new house with a debit card. And then I think we have, it's fascinating. We pay, somebody paid for their taxes, $11,000 in taxes. And we also match when you pay taxes. So go on to the online, and you're paying your taxes, $11,000. We're matching that with $11,000 in investments. And they called us up and said, "This is awesome because not only do I pay a lot of taxes, but I also did the school fees." And so that person did the school fees as well. Those are the two things that individual was particularly upset about, that those were, reoccurring things that, felt heavy in the wallet, but now they're getting something back.
Great applications of it, absolutely.
Yeah.
Yeah, I mean,
this is great.
We're all working hard to get the savings account out. That was originally going to be our first product. It was only because of COVID and other reasons we postponed it. So that's certainly been heavily anticipated. And then the credit card as well. People do think in terms of credit cards. They don't really think about debit cards. So the credit card becomes an important launch for us as well. And then ultimately, our bigger vision is that if we do this right, then of course, hopefully, in a few years' time, people will say, "Why will I ever bank with any or use any other card? Why would I use a card that gives me points that are conditional on, on the bank honoring them, and conditional on me having to go through the whole rigmarole of, deciphering what is worth what and when can I use it and when can I not." We have no categories, no caps, etc. on the credit card, and now you're getting 6%, at least historically, on average. And that hopefully becomes this phenomenon where people say, I will never ever use another credit card than this. Why would I? No, it's entirely, it's up to you. I mean, other than obviously cash transactions when you pull out cash, but spend, no limits on the spend. Yeah. So we like to say spend $1 million, we'll invest $1 million.
There's no exclusions at all in terms of what you use that for. Okay. Cash advance.
He went to sign up for the Save card.
Yeah. Yeah.
1 second, I gotta go.
Ramsey, what last thoughts? Oh, we may have lost Ramsey. May have. I think he did. He's sending me a link. I just got a link. He just did that. He's trying to send me the link, Michael.
Yeah, so I mean, for anybody who wants to sign up,
all right.
Card,
okay, Michael, this is terrific. Okay, you sold me. I'm gonna get
URL of the
web
address is
I'm
joinsave.com. And once you get in there, you can just sign up. It's in it. I'm told.
What's the best way to get in touch with you?
Having signed up myself a long time ago. Yeah, and then off you go and get. You immediately get the digital version of the card, and then the actual physical card comes overnight. Within a day or two, and then go and start investing without putting any outlay. He signed up. There he goes.
I love it. I love it. Okay, well, listen, great to have you on here, Mark. Ramsey, as usual, thank you to all our listeners. And Ramsey?
Hey.
You signed up. You signed up for it.
So obviously it was less than 6 minutes because he's back already.
It was less. He's back. Hey, Ramsey, before we sign off, any last questions for Michael?
No, I just want to congratulate Michael on his journey. I'm a little bit out of breath because I had to run down the street here and come back. Bottom line, I think that the most amazing thing about everything you're doing is creating that daily customer engagement. That's the thing that was most striking to me. So I will continue to follow it with great interest.
Yeah, great. Okay, listen, thanks to our listeners. Hope you enjoyed the show. Send us notes, send us ideas for guests and questions. And otherwise, join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.